To keep yourself updated, subscribe to Indigo Learn and click the bell icon.
Now, to visualize what is a cash flow statement, you can have a look at a cash book. In a cash book, what all do you capture? On one side, you will capture all the receipts or the inflows. On one side, on the debit side of the cash book or the cash account, you will capture all those money which have come into the business. And on the other side, you will capture all the outflows, all the payments, right? On one side, you have all the receipts, all the inflows. On the other side, you have all the outflows, all the payments. Now, if you summarize all these inflows, all these outflows and compare the opening and the closing balance, you will get a cash flow statement. It is as simple as this. So, what do? You plot all the cash inflows, you plot all the cash outflows. Now, inflows minus outflows, it will give you the net movement in cash. For example, the inflows are totaling to 10,000, outflows are totaling to 8,000. So 10 minus 8, net increase in cash should be how much? 2,000. And say you have an opening balance of 1,000. So 1,000 plus 2,000, your closing balance should be 3,000. This is the logic on which a cash flow statement is prepared. What did we do? We summarized all the inflows, we summarized all the outflows, we compared the inflow and outflow, found out how much is the net increase and compared that with the opening balance, we got the closing balance. This summary is what is called a cash flow statement. So when you look at a cash book, what are the various inflows you can assume? What are the various inflows you can visualize? You can collect money from the customers, you can make cash sales, you can get money from the investors, someone has subscribed to your equity share capital, you have borrowed money from somebody or someone has subscribed to your debentures, you have issued preference share capital, you have sold off your fixed assets, even there you will be collecting cash, right? So these are the various things which will appear on the inflow or which are inflows for the organization. Now one thing you need to be very carefully noting is just because I collected some amount from the debtors, that will not be equal to my sales. If I collected 10,000 from the debtors, that is the cash inflow. Maybe possible I have sold goods worth 15,000 to the debtors and that 5,000 is still outstanding. On the payment side, if you see, you would have paid salaries, you would have paid the wages, you would have paid electricity bills, you would have paid telephone bills, you would have made some purchases and you would have paid to the creditors, you would have purchased certain fixed assets or you would have repaid your loan, even that is an outflow. In the inflow side, we said you took loan. On the outflow side, you are saying you have repaid those loans. So there are various items which also come on the payment side. Now just if I give a statement, total cash inflow 10,000, total cash outflow 8,000, opening balance, closing balance, will that make any sense? It will not make any sense. So we have to logically structure, we have to logically summarize all the inflows, all the outflows, group them under appropriate heads and present the cash flow statement. Now as we just now said, you cannot club all the inflows, club all the outflows and make a statement and say this is the inflow, this is the outflow, this is the closing balance. What will investors get out of that? What will your father as an investor get to know of such a statement? So it is important to properly classify. So what we need to do is we need to appropriately group related items and segregate them into different categories. Now how do we do the segregation? For that we have to go and see our P&L and the balance sheet. If I have to show you a P&L, now when I am saying P&L, I am referring to trading profit and loss account, your entire set, right? If I look at your P&L, what all do you see in your P&L? You will see something called as by sales or your income part here, correct? Then you will have purchases, you will have to sundry expenses, maybe direct, indirect and all those things. You may have interest payment on loans, correct? You may have depreciation. So like this you can have many expenses, you can have many income, right? Now apart from this, obviously you will have something called as opening stock here, closing stock here and all those things. If you come to your balance sheet, broadly you will have capital, loans, other liabilities. So basically your current liabilities, and on the asset side you will have fixed asset then your investments and your current assets. Inside these current assets, you will have cash, which includes your bank balance, and others, right? Others would include inventory. So you'll have maybe you'll have inventory, you will have your debtors, and so on. So this is the broad picture of your balance sheet and P&L. It is not in the proper format, but these are the items largely you will see. Now under expenses, you can have any kind of expenses. You can have depreciation, you can have interest, you can have any other expenses that is payable. And on the asset side, under current assets, you may have multiple current assets. But this is the broad picture of your balance sheet and profit and loss account. Now what we need to understand is how do we classify the various inflows and outflows. Now first let's look at the P&L account. Now if you look at the P&L account, there is one item called depreciation. Now tell me one thing, when I am booking this expenditure, when I am booking depreciation expenditure, is there any cash outflow? Am I paying something or am I paying some amount to some person for charging this depreciation? Now you may say, sir, we purchased fixed assets 5 years back. At that point of time we paid. Yes, we paid at that point of time. We paid at the time of purchase of fixed assets. But are we paying anything when we are charging depreciation? The answer to that is no. Similarly, you can have something like to provision for bad debts. Will I pay anything when I am charging provision for bad debts? I will not pay. I would have provision for taxation. Will I pay something when I am creating provision for taxation? No, I will not pay anything when I am passing the entry for provision for taxation. But yes, when I am paying the taxes, I will show it under taxes paid or advanced taxes paid. There definitely there is a cash outflow. So first thing that you need to understand is there are some items in the P&L account which are non-cash items. These are called non-cash items, which will not result in inflow or outflow of cash either today or in the future. Now you may say, sir, for provision for taxation, we'll pay in the future, right? Now when you pay that, that will be separately shown as taxes paid. But for charging this expenditure, you will not get any cash inflow or cash outflow. Now if you look at other items, sales, when you make sales, either today you will collect cash or in the future you will be collecting cash. You say purchases, either you will pay today or you will be making a payment in the future. You come to other expenses, either you will make payment today or you will be making payment in the future. Other than those items which are non-cash, just because you have said to provision for bad debts, will you pay something in the future? You will not pay anything in the future. Provision for taxation, again as I said, it is a provision only. When you make the taxes payment, you will debit it to advance taxes paid and later on set off the advance taxes and provision for taxation. These are called non-cash items. Now, all those items which are related to your day-to-day operations. Now what do I mean by day-to-day operations? I purchase certain goods, I carry out the manufacturing activity, I sell those goods, I incur expenses towards salary for manufacturing, I incur expenses towards electricity for running the plant and machinery, I incur expenditure on transportation for bringing the goods into the factory, sending the goods out of the factory. All those expenses which are linked to my day-to-day operations, core activity, those are called operating activities. What are those called? Operating activities. Now you may say, sir, how do we get to know that particular activity is operating activity or not? You look at the nature of the enterprise. Now for Reliance Industry, when they purchase raw material, when they convert those raw material into finished products and then they sell those finished products, that is the operating activity. For some company like Tata Motors, when they are buying, when they are getting all the components, assembling it into a car, selling off the car, that is their operating activity. What does the enterprise do on a day-to-day basis? That is what is called an operating activity. And some things may be incidental to that. You have sold scrap. That is not your core activity, but still it is incidental to your core activity. Anything related to your core operations or core activities is classified as operating activities. That is the first thing that you need to know. Now, if you see the P&L account, something related to sales, something related to purchases, expenses, Sir, is opening stock, closing stock related to operating activity? Absolutely yes. So even this part, these are your operating activities. Then something which is in the balance sheet that is related to these items, even those are your operating activities. Whatever is the cash flow generated out of these operating activities, that is either inflow of cash or outflow of cash, are classified as cash flow from operating activities. What is the first category? Cash flow from operating activity. So when you make sales, either you would have made sales in cash, you will collect money, or you would have sold to a debtor and in the future the debtor pays you some amount, that is called a cash flow from operating activities. Similarly, you made some purchases. Now for those purchases, either you would have paid money immediately or you will pay money in the future. Now even this is classified as cash flow from operating activities. Similarly, some expenses, when you make the payment for those expenses, they are classified as cash flow from operating activities. Now linked to these items are items of debtors, inventory, maybe here you have trade payables, right? So whenever you are making payment to trade payables, that will be classified under operating activity. What is the first category of cash flow? Cash flow from operating activity, which considers cash inflows and outflows from your core activities or core operations or principal activities. That is the first category. Now, when you come to the asset side in the balance sheet, there are some more items like you have fixed asset here, you have investments here. Now tell me one thing, why would someone purchase a fixed asset? Let's say, why would someone build a plant and machinery? Now the idea is you build a plant and machinery, use that plant and machinery to generate future economic benefits, correct? You have built a plant and machinery, you will use that for production, that production will be sold, you will get money out of that. That is the whole intention, correct? So you have fixed assets where you have put in money to generate future economic benefit. You could have some investment. Let's say you invested in shares of a company. Why would you invest in shares of a company? So that you will get income by way of dividend or there is capital appreciation. So some form or the other you will get future economic benefits. So if you look at these two categories of fixed asset or investments where money is spent today to get future economic benefits, these are classified as investment activity. These are classified as investment activity, and whatever is the amount that you pay or spend maybe to purchase a fixed asset or to purchase certain investments, these are classified as cash flow from investment activities. Now one thing I want all of you to keep in mind is, for accounting purposes, fixed asset is dealt separately, investments are dealt separately. Fixed asset you cover under AS 10 and investments you cover under AS 13, right? For accounting purposes, though you show them differently, for cash flow purposes, it is considered as if these are the amounts invested in the business so that the business can run smoothly and you can get future economic benefits. So whatever is the outflow towards fixed asset, you will classify it as cash flow from, cash outflow from, or cash outflow towards investment activity. Whenever you are purchasing investments, you will show it as cash outflow towards investment activity. We'll say at a future date, you sold off certain fixed asset, then you will call it cash inflow from investment activity. You sold off the investments, cash inflow from investment activities. You purchased this investment, you got dividends. Now when you got dividends, where will you show in the P&L? You will show on the credit side by dividends, right? By dividends. Now whenever you are getting this income from investments, now because investment has been classified under investment activity, even these dividends will be shown under investment activity. So fixed asset is under investment, investments are also under investment activities. Now related to the fixed asset, in the profit and loss account you have something called as depreciation. Should I classify this as cash flow from investment activity? The answer to that is no. And the reason is, depreciation is not a cash outflow. We already discussed, it is a non-cash item. So though you have depreciation related to a fixed asset which you have shown under investment, you should not show it as cash flow from investment activities. Then we are done with the fixed asset part, investment part, items of current assets, and we are done with items of current liabilities. Now if you see, there is something called capital. Now, when do you take capital? You take capital to fund the business, to start the business. These are your primary sources of funds, right? And you also take loan to fund the business. In other words, you are taking finance, or you are financing the business with the help of your capital and loans. So these activities, the activity of taking capital or issuing share capital, collecting money, taking loan from banks, issuing debentures, these are primarily to finance the business, and they are classified as financing activities. So if you get money from shares, you will say cash flow from financing activity. If you get money from loans, you will say cash flow from financing activity. Now for this loan, you have paid some interest. For this loan, you have paid some interest. The rule is, if this is classified as financing activity, even this should go off as financing activity. So issuing shares, collecting money is a financing activity. Loans is a financing activity. So interest on loans will also be part of a financing activity. Now, when you issue shares, at some point of time you may have paid dividends. Please note, when shares are classified under investment activity, cash outflow out of dividends should also be shown under financing activity. So you have understood broadly the three categories from where we will get cash flow. First one, cash flow from operating activity, then cash flow from investing activity, and lastly cash flow from financing activity. Now we are left with one item, that is cash. Now cash, we will show it as opening balance and closing balance, so there will be a difference on that. And all these inflows and outflows, there will be a difference, and we will reconcile or we will match both these and present it in a statement format. Now if you go back to our original business, when you had started a business, the first case where you had made a profit of 10,000, let us see how will this cash flow statement look like. In this case, the money that you collected from debtors and the money you paid to the creditors, these will be classified as operating activities, and you will say these are cash flow from operating activity. What is the amount? The net amount is an outflow of 10,000. Then shares and loan, these are financing activity. These are financing activity. Money taken to finance the business. You have a net inflow of, so these are cash flows from financing activity, net inflow of 30,000. Now what is the net increase? 10,000 to 30,000, your net increase is 20,000. Your opening balance was 0, your closing balance is 20,000. So you will say opening cash balance 0, closing cash balance 20,000. This is the logic of preparing a cash flow statement. Say in this example, had you gone out and purchased an asset worth 5,000, what would have shown it under? You would have said cash outflow towards investment activity, purchase of fixed asset 5,000. So this is how you will classify the various items and present it on the cash flow statement. Now in the previous case, if you carefully observe, though you made a profit of 10,000, actually you have burnt extra cash in your operations. And how did you get that money from? You took some loan and you used that money to fund your business. So this is how you will be able to understand how is the cash flow position of a business. Let us quickly recap what are the three activities and take some examples and classify those activities. Operating activities are the principal revenue generating activities of the enterprise. So what are operating activities? These are the principal revenue generating activities of the enterprise. So example could be amount collected on sales, amount paid to creditors. All these, which are the core activities or the operations of the entity, are classified as operating activities. So whatever cash flow comes from operating activity will be classified under cash flow from operating activities. Investing activities are the activities towards acquisition and disposal of long-term assets and other investments. So all those fixed assets and investments, they are classified under investing activities. Financing activities are those activities that result in changes in the size and composition of owner's capital and borrowings, which means whatever activities which changes the size of the owner's capital. So that is basically share capital or maybe equity share capital or preference share capital, or the borrowings or the loans of the enterprise. Those are classified under financing activities. Let us take some examples and see how do we classify those items. Say a company purchases raw materials for its operations, or company purchases raw materials for its finished products and makes payment for them. How will you classify the cash flow? Now, when raw material is related to operations, you will say cash outflow. And what is the category of activity? It is an operating activity. But if the same company purchases, fixed assets, you will classify it as cash outflow, but from investment activities. Let's say if Tata Motors purchases cars and makes payment for them, and if these cars are purchased to sell to the customers, you will classify it as cash outflow and you will say it is on account of operating activity. But if Tata Motors purchases cars to use it for its office purpose or for its administrative purpose, then you will say it is a cash outflow, but it is towards investment activity. See, that difference has to be very clear. Something which is related to core activity or core operations, only those activities you will classify under operating activities. Then, if you make payment to suppliers, you will say cash outflow, operating activity. If you make payment of income tax, how should you classify? See, income tax is paid on the profits earned and the profit is earned out of operations. So, income tax paid will be classified as operating activity or cash outflow from operating activity. But there could be a case where you pay dividend distribution tax. Now, if you are paying dividend distribution tax, you are paying it because you are paying dividends to the shareholders, and because payment to shareholders is under financing activity, this dividend distribution tax should be classified under financing activity outflow. If you sell certain fixed asset and if you get money, you will say cash inflow, investment activity. If you collect money from your debtors, cash inflow, operating activity. If you sell goods for cash inflow, operating activity. If you borrow money from bank, cash inflow, financing activity. If you pay interest to the bank, cash outflow, financing activity. If you pay dividends to the shareholders, financing activity outflow. Right? If you repay the debentures, financing activity outflow. So, in this way, you can categorize whether some cash flow is operating, investing or financing. So, what are the three kinds of cash flow we have discussed? Cash flow from operating activity, that is the first one. The second one is cash flow from investing activity. And the third one is cash flow from financing activity. When we say cash flow, what we are referring to is total of cash inflows minus total of cash outflows, or in other words, what is the net cash flow under each heading or under each category. Now, once you know what is the net cash flow under each category, when you sum up all three categories, let's say there is some inflow under 1, there is some outflow under 2 and there is some inflow under 3, and when you sum up all these three, what you get is what is the total cash flow for the company for the particular period. Means what is the total of cash flow? It could be a net cash inflow or it could be a net cash outflow. If it is a cash inflow, we can say that our cash balances have increased, and if it is a net outflow, we can say that our cash balances have decreased. So, summing up cash flows from three activities will give us net increase or decrease in cash and cash equivalents. See, so far we have been talking about cash flow, cash flow, cash flow. When we say cash, we are referring to not only cash but also cash equivalents. What are these cash equivalents? We'll discuss in some time. So, the sum of cash flows from three activities will tell you whether there is an increase in cash and cash equivalents or whether there is a decrease in cash and cash equivalents. Now, if you compare this increase and decrease with the opening balance, let's say there is an increase in cash, and if you see the opening balance, if you add the opening balance and the increase, you will get the closing cash and cash equivalents. This is the structure of a cash flow statement. This is what is also prescribed by Accounting Standard 3. So, in this, what do? We plot the cash flows from three activities, that is operating, investing and financing. Please remember the order: operating first, investing second, financing third. Sum these three up, you will get net increase or decrease in cash and cash equivalents. To this, you add the opening balance or the beginning balance of cash and cash equivalents, you will get the ending balance of cash and cash equivalents. Now this is the structure. What we need to understand is how do we compute cash flows from each activity, then what all are classified under cash and cash equivalents, and finally when you do the statement should match, meaning to say the total increase should be equal to the difference between closing and opening balance. So we need to spend good time in understanding how do we calculate each of these cash flows and how do we derive at the net increase and the opening and the closing balance. That is where we'll be focusing maximum of our time. Now this is the format in which you will prepare the cash flow statement. You will classify them into 3 activities and you will plot the relevant cash flow. Now one very important thing is, before you start preparing this statement, you must be comfortable in identifying as to which item falls under which category. Correct classification of each item is very important, because if you wrongly classify an item, let's say some item is an operating item but you classify it as a financing item or an investing item, you will not get marks for that. So not only the total amount should match, also the classification has to be proper. And we have already understood how do we classify the various activities, and as we solve more and more problems, we will understand in depth special issues that may come up. So first thing is, you have to identify which category does the relevant cash flow belong to. Then second is obviously compute the cash flow, and finally the net increase and decrease is nothing but the difference between the closing and the opening balance. So you have a checkpoint there where you can see whether your cash flow has tallied or not. Now a question you may have is, for which period should we prepare this cash flow statement? The answer to that is very simple. The period for which you are preparing the financial statements. If you are preparing the financial statements for 2019-20, that is for the year ended 31st March 2020, your cash flow statement will be for the year ended 31st of March 2020. If you are making it for a quarter, cash flow statements will be for that quarter. Cash flow statement is not on a date. Cash flow statement summarizes the cash flows during the period, so it has to be for the period. The next question is, who are required to prepare these cash flow statements? Now for this, I will divide the entities into 2 categories: companies, other than companies. Now when we talk about companies, Companies Act 2013 requires every company to prepare a cash flow statement. Now why is that? That is because if you look at the definition of a financial statement, it includes a balance sheet, a profit and loss account, a cash flow, a statement of changes in equity, and any explanatory note. So these are the things which form part of financial statements. Now when Companies Act mentions that you have to prepare financial statement, or a company has to prepare financial statements, cash flow statement is a part of the financial statement, and hence it is mandatory for every company to prepare financial statements. However, Companies Act has made an exception to 2 types of companies. One is one-person company and second one is a small company. So if a company is a one-person company or a small company, they are not required to prepare cash flow statements. Other than that, all other companies under the Companies Act of 2013 are required to prepare cash flow statements. Coming to other entities, if they are level 1 enterprises or if they are level 1 entities, they have to prepare cash flow statements. But if they are level 2 and level 3 entities, they need not prepare cash flow statements. So largely speaking, all the companies except small company and one-person company, they have to prepare cash flow statements. If you talk about non-companies, then level 1 entities, they have to prepare cash flow statements. Level 2 and level 3, they need not prepare cash flow statements. Now what we will do is, we will take up each component of the cash flow statement and understand that in detail. We will begin with cash and cash equivalents and then move to other sections. Now when I ask you what are cash and cash equivalents, you would say, sir, cash part is very simple. Whatever is the money we have, whatever physical cash we have, whatever the currencies we have, that is what we call as cash. That is what we refer to as cash balance. This is our general understanding. In general sense, whatever is the physical currency, that we refer to as cash. Let's say I have deposited some money into the bank, then I'll call it my bank balance. But for the purpose of AS3, we have to unlearn this concept and understand cash in a different way. For the purpose of AS3, cash includes cash in hand and demand deposits with bank, which means whatever physical currencies you have, whatever the balances you have with you, that is definitely cash. But apart from that, whatever money you have kept with the bank in demand deposits, that also forms part of your cash. Now, what is this demand deposits? To put it very simply, demand deposit is a deposit which has to be repaid to you on demand. For example, you deposit 10,000 rupees in your savings account today. Okay, so you have opened a savings account where you have deposited 10,000. Tomorrow when you go to the bank and ask the money back, the bank will have to pay you back. The bank can't say that I will not pay you, because the amount is repayable on demand. Whose demand? The demand of the depositor. So when you as a depositor deposit money into your current account or in your saving account, that is a demand deposit, because that has to be paid to you when you demand that. Such deposits which are repayable on demand are called demand deposits. So then what are the other kinds of deposits? There is something called a time deposit. When something is called a time deposit, it will be repaid only after a fixed period of time. Say for example, when you go to a bank and you open a fixed deposit for, let's say, 1 year, the bank will not pay you whenever you demand it. The bank will pay you only after 1 year. Now sometimes what may happen is, you may ask the bank to shorten the duration and close the deposit in advance and pay the money back to you. The bank may pay the money back to you, but when it pays back the money, it will charge some penalty from you. But when you ask the bank to give your savings account money or current account money, it will not charge any penalty. But if you open a fixed deposit for 1 year and you want the bank to pay you back in 7 days, the bank will definitely charge some penalty. So that is the difference between demand and time deposit. Demand deposits are repayable on demand. Time deposits are repayable after a fixed period of time, right? So what does cash include? Cash includes cash in hand and demand deposits with bank. Now we have understood the meaning of cash. What is cash? Cash on hand plus demand deposits with bank. Now we will understand what is the meaning of cash equivalent. Now what is this cash equivalent? Cash equivalent is something which is very close to being cash, but it is not cash. Say for example, you went to a bank, you opened a fixed deposit, you kept your money for 15 days. So you have opened a fixed deposit for 15 days only, and you have agreed with the bank a specific rate of interest. Now if I have to ask you, do you know the amount that you will get after 15 days? The answer to that is yes, because you know the principal, you know the rate of interest, you know the duration. So you will know after 15 days what is the amount that you will get, right? Now when you know what is the amount will you receive after 15 days, now if I have to ask you, how much confident are you that you will receive the same amount that you have computed? You will say, sir, I am 100% sure that I will receive that specific amount. Why is that so? Because you know that there is very remote chance that bank will pay you something else, or the bank will close down and you will not get the money. The chances of that are remote, they are very insignificant. So such investments which are short term in nature, which are highly liquid, which can be converted into known amount of cash. So today you know that this investment will fetch a specific amount of cash after a certain period, and there is an insignificant risk that the value of that investment will change. Means, let's say you have estimated that you will receive 1010 rupees after 15 days. There is a very less chance, there is an insignificant risk that 1010 will become something else. Such kind of investments are classified as cash equivalent. So what are the 4 things you have to check? Short term, highly liquid. Highly liquid means you must be easily able to convert that into cash. Something like if you invest in land, is land a liquid investment? No, land is not a liquid investment, because you will not be able to convert a piece of land into cash very easily, right? So that is a illiquid investment. So you have to consider short term liquid investments which can be converted into known amount of cash, meaning to say you must be 100% sure, or you must be 99.99% sure of the amount you will get when you convert that investment. Now let's say you have invested in shares. You want to sell them off in 7 days. Are they liquid? Yes, shares are liquid, but Do you know what is the amount you will get after 7 days? The answer to that is no. If you are selling equity shares in the market, you will not know after 7 days what is the amount you will get back. So shares cannot be classified as cash equivalents. On the other hand, let's say you had purchased preference shares. Which are maturing in, let's say, 15 days or 30 days time. Now in case of preference shares, you are almost sure of the amount you will be getting. So that can be classified as cash equivalent. But also when you are classifying preference shares as cash equivalent, you must see the fourth factor. What is the risk of changes in value? If the risk is insignificant, then you may classify it as cash equivalent. But if the risk is significant, you are unsure as to what is the amount you will get, then in that case, you will not classify it as cash equivalent. So we have understood what is cash, what are cash equivalents. Cash comprises of cash on hand and demand deposits with bank, whereas cash equivalent comprise of those short-term highly liquid investments which can be converted into known amount of cash, and there is insignificant risk that the value will change. This is what is cash and cash equivalents. Now the reason we have spent a lot of time in understanding these two concepts is whenever there is a movement between cash items or cash and cash equivalent items, such movements are not classified or are not considered as cash flows. What does this mean? Let's say I have 1000 rupees with me. I deposited 500 rupees in the bank. Is this a cash inflow or is this a cash outflow? This is neither a cash inflow nor a cash outflow, right? When we are preparing cash flow statements, amount moving from one part to another within the cash bucket or within the cash equivalent bucket or between cash and cash equivalent bucket, such items are not considered as cash flow. When you deposit money into bank and you create a fixed deposit and that fixed deposit is only for 1 month, then it will not be considered as cash flow. But if the fixed deposit is for 5 years, then you may classify it as cash flow from investment activity. That is the reason why understanding of what cash is, what cash equivalent is very, very important. So in the balance sheet, whenever you see cash and cash equivalents, cash, balances with bank, short-term investments, highly liquid short-term investments, exclude that from your cash flow computation. And where will you show them? You will show them as either opening cash balance if it is the opening balance, or as the closing cash and cash equivalent if it is the closing balance. Now we have understood how do we prepare cash flow statements using the direct method. What do we do in that? We simply summarize the cash book or the cash account, pick up relevant inflows, classify them under different activities, and for each item we get to know how much is the inflow, how much is the outflow, and we present that in a particular format. That is how we prepare cash flow statement using the direct method. Now one disadvantage of using this direct method of cash flow preparation is nowhere are we able to correlate the cash generated from operations or the cash flow from all the activities to the net profit. How much is net profit related to the cash flow? Or if a question were to be asked that okay, a company is doing great, it is earning a lot of profits, but cash flow is not sufficient, the company is not able to generate cash flow. Such kind of interpretation cannot be made if you use a direct method. For this purpose, we have another method called the indirect method. Which method? Indirect method. Now in the indirect method, the approach is you first start with the profit figure, generally profit before taxation. You start with profit before taxation figure and do a lot of adjustments to find out what is the cash flow from operations. Now when you do this activity, you get a clear picture as to okay, this was the net profit of the company, but the company could generate only so much amount as cash flow. So that relationship can be established if you are using the indirect method. Now as far as financing and investing activities are concerned, the way you treat them under direct method is nowhere different from the way you treat them in the indirect method. So the presentation of investing activities and financing activities remains the same under both the methods. What changes is cash flow from operations. So you start with net profit, you adjust certain items, you add some items, you deduct some items, and then you arrive at cash flow from operations. Now, one peculiar problem in cash flow statements which many students face is how do we do these adjustments, and a lot of students are into the habit of by hearting the adjustments. Now, what I suggest is don't learn these adjustments by heart, because if you learn them by heart, there is a higher chance that if you forget them, you will make a mistake. We'll understand the logic of each and every adjustment, why do we add certain items, why do we deduct certain items, and then proceed to solve the problems. Let me tell you, if you understand this part of the cash flow logically, you will never ever forget in your life. You will never find a challenge to tally the cash flow statement. In fact, I have seen a lot of times people not only struggle to tally the balance sheet, they also struggle to tally the cash flow statement, because for most of the companies, cash flow will be prepared using the indirect method. We'll take a small scenario, we'll keep on adding adjustments to that and understand how do we prepare this cash flow from operating activities using the indirect method. So let's first take a simple profit and loss account with couple of transactions and see how can we prepare this cash flow statement using the indirect method. Now, general in profit and loss account, on one side you capture all the expenses and on the other side you will capture all the income. Now, we are still using T form, that is purely for our understanding purpose. Now, let's say in a particular year a company has made sales of 1000. A company has made sales of 1000 rupees. Against that, the company has made purchases of how much? Let's say 700 rupees, right? There is no opening stock, there is no closing stock, right? So, this is a simple transaction and there are no other expenses, let's assume for now. And when I say profit and loss account, I mean trading profit and loss account. So, what is the net profit? We know the net profit is 300, right? 1000 of income, 700 of expenses, 300 is the net profit. Now, if I have to ask you one question, let us assume this company or this business that we are talking about, it deals only in cash transactions, meaning to say all their sales are in cash, all their expenses are also in cash. So, whenever they make sales, they will collect cash from the customer. Whenever they make purchases, they will pay cash to the supplier immediately. Now, for the year, there are no opening stock, there are no closing stock, there are no outstanding debtors, there are no outstanding creditors. If I have to ask you, how much cash did this company generate during the year? You will simply say, sir, sales 1000 inflow, 700 purchases outflow, cash flow is nothing but 300, right? Now, in this case, because there are no other adjustments, there are no other transactions, everything is on cash, we said 300 is the cash flow. Can I say that this net profit, which is equal to 300 in our case, itself is the cash flow? Assuming there are no opening stock, closing stock, no other adjustments and everything is happening in cash, right? But generally, does it happen this way? It doesn't happen this way. So, let us add one more element to our profit and loss account. Let us see what happens after that. So, let's assume there was an opening stock of 100, there was an opening stock of 100 and there is a closing stock, of say 150. So, what happened here? We have those 700 of cash purchases, 1000 of cash sales and on the top of it we have 100 of opening stock, 150 of closing stock. Now, will the profit remain 300? The profit will not remain 300. Let us see how much will be the profit. So, 1000 plus 150 will make it 1150 and this side also the total becomes 1150. I no longer will have 300 of profit. My profit will be 1150 minus 700 minus 100. My profit is 350. So, this 300 now becomes 350, right? Now, if I were to ask you the same question, what is the cash inflow for the company? What would you say? Sir, inflow of sales 1000, outflow on purchases 700, 1000 minus 700. The cash flow still is 300. The net cash inflow is still 300. Now, is this cash flow equal to my net profit? See, my net profit is 350. My cash flow is equal to 1000 minus 700. My cash flow is only 300. This is not equal to the profit. Why is that case? The reason being, when I was calculating this net profit, what I did was, I added 150 here and I deducted 100 from here. That's why my profit became 350. But if I have to see only the cash transaction, my cash inflow is 300. Now, if I have to reach from 350 to 300, what should I do? Whatever I had added earlier, I will deduct. Whatever I deducted earlier, I will add to reach at the cash flow related item or to reach at the net cash flow. Because again, what I am saying here is all my purchases are cash basis, all my sales are cash basis. So, if there is an opening stock element and closing stock element, if I have to eliminate that, because there is no cash flow on account of opening stock or closing stock, because there is a closing stock credited to my profit and loss account, I do not get any cash inflow. Because there is opening stock debited to the profit and loss account, I do not have any cash outflow. These two items are not resulting in any cash flow. So what will I do? I will eliminate that. So what I will do is I will add this 100 and I will reduce this 150. In other words, can I say whatever is the difference in opening stock and closing stock? In this case, 100 and 150, difference is only 50. This 50 I should adjust. Now, how will I adjust that? If you see, my closing stock is higher than my opening stock. So, this particular closing stock I will reduce, opening stock I will add. In net effect, I will be reducing 50 because minus 150 plus 100 makes it minus 50. So, to this net profit of 350, if I adjust change in inventory minus 50, I get 300, which is nothing but equal to my cash flow. So, it's very simple. To the net profit, I will have to adjust the impact of closing and opening stock. Now, should I add, should I deduct? The simplest way to remember this is, you simply do opening stock minus closing stock. You do what? Opening stock minus closing stock. That is the net impact on the profit. Now, if that is a negative number, because if closing stock is higher, net profit will be inflated or net profit will be higher. In our example, 100 was the opening stock, 150 is the closing stock. Since closing stock is higher, my net profit will also be higher. To bring that down, I will have to reduce. So, a simple formula to remember this is, if you simply say opening stock minus closing stock, whatever the number comes, that has to be adjusted. In our case, it was 100 minus 150, so minus 50 you have to reduce. Let us take the other situation. So, let us take another situation where opening stock is 200, closing stock remains at 150. Now, 1000 plus 150 is 1150, 1150 minus 900, what is the profit I get? I get a profit of 250. So, this 350 now becomes 250. Will my cash flow change because of the changing inventories? The net inflow that I have, that is amount collected from the debtors or amount collected on sales minus amount paid on purchases, is there any change that will happen because I change the closing and opening inventory values? It does not change. What amount I collect from the customers remains at 1000. What amount I pay to the supplier remains at 700. So, the cash flow does not change. Now, what is happening here? Opening stock is higher, closing stock is lower, which means to that extent the impact of opening stock minus closing stock on the net profit is the net profit has actually come down. So, we need to add back. What is the amount that we need to add back? 200 minus 150, we need to add back. So, minus 50, it has to be plus 50. 250 plus 50 makes it 300. If I have to see in this equation, just see opening stock minus closing stock. So, this is scenario 1, this is scenario 2. Opening stock minus closing stock. What is the opening stock? 200 minus 150. In this case, I have to increase it by 50. There is no need to by heart that if inventory increases, I have to reduce. If inventory decreases, I have to add. Don't do it that way. Simply, one way to understand is compare the opening stock and closing stock and find out the impact on profit. Because opening stock and closing stock does not impact the cash flow, the impact of the difference of these two will be eliminated. How to do that in a simpler way? Simply find out what is opening stock minus closing stock. Whatever is the resulting number, that will be the impact. Are we clear? So, and the reason for giving that impact is opening stock and closing stock, they do not result in cash flows. The impact of that will be eliminated from the profit to arrive at the cash flows. Now you may say, sir, will we always have sales being in cash only, purchases being on credit only? No, we will not have those scenarios. Now as we move ahead, we will add items as credit sales, cash sales, and keep on building this example so that by the time we have discussed enough number of adjustments, you will be comfortable in computing cash flow from operating activities. Now continuing with the same illustration, we'll do a minor change. Now what is that change? So far we said all purchases are on cash basis, all sales are also on cash basis. Now we'll make a slight change to this. We'll say purchases are on cash, fully purchases are on cash. So 700 is the cash outflow, but sales are on credit basis. Sales are on credit basis, right? Now if sales are on credit basis, you will have some amount in the opening debtors, you will have some amount in the closing debtors, right? You will have some balances receivable at the beginning of the period, you will also have some balances at the end of the period. So let's say for example, debtors to balance brought down, the opening balance I am talking about, to balance brought down is 150, okay, and the closing balance, that is by balance carried down, is 225. Opening balance 150, closing balance 225. Now in the entire year we have made sales of 1000. This we will debit to the debtors account, right? So to sales 1000. So if you see the debtors account now, 1000 plus 150, here you have 1150. This side also it should be 1150, and now there is a gap here. How much is the gap? The gap is 1150 minus 225, that gives you 925. Now this 925 is the gap. Now what would be the possibility of these gaps? If you look at the P&L, there are no other items, there are no other transactions. Nowhere are they saying there is some bad debt or something. So we can safely assume that this 925 is nothing but the amount that we would have collected from the debtors. So by bank, this is your balancing figure. We can simply assume that 925 is received from the debtors. 925 is received from the debtors. Now there could be a scenario where I will write off something as bad debt. If that was the case, then this would not have been 925, it could have been a lesser amount, which we will see as we move further. But for now, because there is no other information, sales are made on credit, opening balance was 150, I made sales of 1000, closing balance is 225, which obviously means the balancing figure of 925, whatever I have, is the amount that I have collected from the debtors, right? Now, I said we will assume all the purchases are on cash basis only. So 925 collected from the debtors, 700 paid to the creditors or paid towards the purchases. What is the net cash flow? The net cash flow is 925 minus 700, 225, right? So let us write that. Is equal to 925 minus 700, 225. 225 should be the cash flow from operating activity. If you would have done it under direct method, you would have said cash collected from customers 925, cash paid to suppliers, 700, the balance is 225. Now, but when we are doing it under the indirect method, we have to again link it back to the net profit. How much is the net profit? The net profit is 250. So, if I have to link it with net profit, I will say net profit for the year is given as 250. Now, is this 250 the cash flow? The answer to that is no. And why is that so? There are two items now. First, there is an opening stock and closing stock difference which sits in this net profit, which is not a cash flow, which does not impact the cash flow. The next thing is this 1000 which got into computation of this 250 has not been realized in full. We have not received full amount towards this 1000. If we see the debtors account, we can see 1000 was what was sold. we got only 925 and there was still an opening balance, which means for sure we have not collected 1000 fully. Now there could be a scenario in some cases where we collect more than what we have sold because there is some opening balance, but for now we can comfortably say that this 1000 has not been collected in full. So the amount that has gone into the computation of net profit has not been realized in full. So if I look at this net profit, this is not fully in cash. I have to do some adjustments. To arrive at the cash flow. What are those adjustments? The first adjustment is towards the opening stock and closing stock. So I'll write one adjustment for changes in stock, right? Opening stock and closing stock. How much is that? 200 to 150. Opening stock was 200, 150 is the closing stock, the change is 50. Now because of this reduction in opening stock or closing stock, what will be the impact on net profit? See, you have debited a higher amount, you have credited a lower amount. 200 is higher, 150 is lower, so net profit would have been reduced. So to increase that, what I will do? I will add back, or using the other technique that we just now understood, I will simply say opening stock minus closing stock. Opening stock minus closing stock, 200 minus 150, 50 is what I will add. Now 250 plus 50 makes it 300. This is in relation to stock. Now come to the debtors portion. How much is sales? Sales is at 1000. This would have resulted in increase in the net profit because we are crediting to the profit and loss account. But how much of this has been realized in cash, or out of this 1000, how much did we collect in cash? That is the question. Now if you come down to the debtors account, I want you to do a small analysis. What was the opening balance? Opening balance is 150, right? Opening balance is 150. How much have we sold? We have sold 1000. So total to the debit is 1150. Now we have a closing balance of 225. Now for a moment let us assume that this 150 in entirety has been collected from the debtors. So whatever was the opening balance, the debtors have come and paid us. I am just giving an assumption, right? Now if 150 has been collected from the debtors, out of this 925, how much has been collected towards the current period? So if 150 is from the opening balance, 925 minus 150, 775 has been collected for the current period. So this 925 comprises 150 of opening balance and 775 from the current year's sales. So out of 1000, we collected 775, the balance 225 is nothing but the closing balance. This, what I can say, is the logical breakup of the debtors account. If you look at the cash flow from debtors, it is 925. How did we get this 925? One thing is 150 plus 1000 minus 225. Did you not do it that way? Now 150 plus 1000 minus 225 is the cash flow from the debtors. If I just write it down here, cash collected from debtors is nothing but 150, which is your opening balance, plus sales of 1000 minus the closing balance of 225, and we assume that this 225 is entirely out of 1000. Either way, whether you assume or not, this number will be the same. So 150 plus 1000 minus 925, we got 925. Come to this profit and loss account. In the profit and loss account, if you carefully observe, while computing this 250, we have already considered 1000, which means this amount was 250 was reached after adding 1000. But we very well know that out of this 1000, entire amount has not been realized. There is a portion of 225 which has not yet been realized. Now, in this 250, we said this 1000 is already included. In the 250,000 is already included, but we will have to reduce this 225 which is not collected, correct or not? We have to reduce this 225 which was not collected, and we have to add this 150 which was collected. I am repeating once again, this 1000 is already included in 250 because when we computed the net profit, we simply added 1000 rupees towards the credit of profit and loss account. Out of that 1000, we know that 225 is not collected. So what should I do? I should say, because I have already included 250, I have to reduce 225 which is not yet collected, and I have to add 150 of the opening balance which I already collected. So what happens? 225 minus 225 plus 150, the net impact is minus 75. This is the net impact. So what did I do? Closing balance of debtors, opening balance of, so this 225 is nothing but the closing balance of the debtors, 150 is nothing but the opening balance of the debtors, the net impact is minus 75. So you have 200, so you have 250 plus 50, that is changes in inventory, minus 75. How much does that come to? 250 plus 50 is 300, minus 75 is 225. Now this 225 is nothing but your cash flow. This 225 is nothing but your cash flow. What did we do in a nutshell? We know that the 1000 of sales is already included in net profit. So I will not adjust for that, but I will adjust for the amount that has not yet been collected, which is the closing balance, and amount that has been already collected, that is the opening balance of 150. So 150 and 225 is what needs to be adjusted. I will add 150, I'll reduce 225. The net impact will be adjusted in the cash flow. If I have to put in other words, what I can do is, the adjustment from debtors will simply be again opening balance minus closing balance. Opening balance minus closing balance. What is the opening balance? 150. Closing balance 225. Net impact is minus 75. In effect, what I am trying to say is, this 1000 of sales is already correctly factored into the difference of opening and closing balance is what I need to adjust. So that is what I have done when I got 75, and that gives me a net cash flow of 225. Now you may say, sir, will it make a difference if we assume that opening balance was not collected at all and only out of the current year balance we have collected the money? In the numbers, it does not make a difference. For a moment, let us assume that 150 was not collected at all. This 925, whatever has been collected, is out of this 1000 only, which means I have added 1000 as sales to arrive at the net profit, but I did not collect 1000. How much did I collect? I collected only 925. What is the adjustment I should do? 1000 minus 925, 75 rupees I should reduce, because to that extent I have not collected. That is not yet my cash inflow. So the net adjustment of 75 does not change. The reason why we split into opening and closing balance is to understand that, okay, opening balance we have collected, that is what we need to add, because opening balance we have nowhere considered in the profit and loss account. Closing balance we have not yet collected, right? So that portion should be excluded, and that closing balance is out of the current year portion only. Whichever way you look at the numbers, if you say, okay, opening balance I have not collected 150, you don't need to make any adjustment. But out of the current year sales, that is 1000, you collected only 925, still you have to adjust 75, which is nothing but the difference between your opening balance and the closing balance. So the two rules that we need to remember: for inventory, opening inventory minus closing inventory; for debtors, opening debtors minus closing debtors. If it is a positive number, you will add to the net profit. If it is a negative number, you will reduce from the net profit. Now let's add one more dimension to the same numbers. Let's say the purchases, instead of being in cash, these are also now on credit. Now when I say credit, it could be partly cash, partly credit. To the extent it is partly cash and that is being debited to the P&L, the net profit will come down, the cash flow also would have come down by the same number. So we will understand credit. If it is a mixture of cash and credit, also the treatments remain the same. So to purchases 700 is on credit, and again because we have purchases, let's draw a creditors account. Creditors account. Assume there is some opening balance. So by balance brought down of some 200 rupees, and to balance carried down, let's say of some 150 rupees. I'm just using round numbers. Now when we made these purchases, we would have credited to the creditors account. So you will say by purchases 700. So 700 plus 200 is 900, and this side also if you say 900, there is a balancing figure of 750. So this can be what we would have paid to bank, balancing figure 750. Now, look at the creditors account and debtors account. If I have to ask you, what is the cash flow net? What is the net cash flow from the operating activities? You would say, sir, we collected 925 from the customers, we paid 750 to the suppliers, 925 minus 750, 925 minus 750, which comes to 175, that should be the cash flow. So, if I were to ask you, you will say cash flow is equal to 925 minus 750, which is equal to 175. Now, is it the same as the net profit? The net profit doesn't change, 250. Now, did you see whether we have creditors balance or not, the net profit is not changing. That's why we have to adjust the net profit to show the correct position of cash collections and cash paid. Now, to this 250, what all the adjustments that we will be doing? First adjustment we said opening stock and closing stock, whatever is the difference we will adjust that. So, and second we will do an adjustment of debtors opening and closing. First let us do these two adjustments. Cash flow from operating activity. Now, this is not the fair format. After we understand the adjustments, we will do a problem and understand how to present it properly as per the cash flow format. So, cash flow from operating activity, first you find out what is the net profit. Net profit is given as 250. Then we will have addition or deduction on account of changes in stock. So, you will say change in stock. Now, I think by now you would be comfortable. You can simply do a opening stock minus closing stock. 200 minus 150, the number is positive. So, you will add back plus 50. Then change in debtors, change in debtors. In change in debtors, again opening balance 150, closing balance 225, the net impact will be 75. The net impact will be 75, but will it be plus or minus? You have to do opening minus closing. 150 minus 225 minus 75. So, you say minus 75. Now, if you say 250 plus 50, 300 minus 75, you get to this level, you get 225 of cash flow. But if you see, our cash flow is 175, and why is that? Now, if you look at the creditors account, you actually paid 750. How much did you purchase? We purchased only for 700. We made purchases of only 700. We have paid in total of 750. Means we paid something also out of the opening balance. So, that is one way of looking at it. The other way of looking at it is opening balance of 200 we have paid in full. Opening balance of 200 we have paid in full. So, the 750 comprises of opening balance of 200 and the balance part, that is 750 minus 200, 550 for the current period. That is how you have the closing balance. 700 minus 550, 150 becomes your closing balance. Or if you look at it in the other way, 700 you paid in full, the extra 50 you paid towards the opening balance. Either ways it is fine to look at. Now, again using the same logic as we did for debtors, what is your opening balance? 200. So, if you look at this creditors account, if you have to find out how did you arrive at this amount paid, what did you do? Opening balance plus purchases minus closing balance is the amount paid. So, if you summarize the creditors account, we said we have opening balance of 200, then purchases of 700, and we had closing balance of 150, which resulted in a payment of 750. And we said that let us assume the opening balance has been paid in full, and out of the purchases entire amount has not been paid, which means now out of the 750 that has been paid, 200 was paid towards the opening balance, that is the opening balance portion, and out of the balance has been paid for the current period, that is 750 minus 200, 550 has been paid for the current period. This gives us the total of minus 750. Now, if you look at the profit and loss account, what did we do? We have reduced purchases in total. We have reduced the purchases of 700 while arriving at the net profit. So, what did we do? We actually deducted 700. How much should we have deducted? We should have deducted only 550 from the cash flow perspective, and we also should be deducting this additional 200, right? Because this 200 has been paid, though it was of the previous period, amount has gone out in the current period. If I have to say this 200 is not yet deducted, this 200 is not yet deducted to arrive at the net profit. So this is one number which I have to reduce, and because I have reduced 700 instead of 550, the difference I have to add back. What is the difference? That is the closing balance. So if I add back this, I get a net impact of minus 50. I get a net impact of minus 50. This has to be adjusted to arrive at the cash flow. This has to be adjusted to arrive at the cash flow, because friends, the point is 700 is not my cash flow. I have reduced 700, but I said I will have to reduce only 550 because that is what I have actually paid. Similarly, I did not adjust for this 200. I have to adjust that. I have to reduce that number while computing the cash flow. Now, this opening balance and this closing balance, the difference of 50, that is a minus 50, I have to adjust. So come here and you will say plus or minus change in creditors minus 50. So 250 plus 50, 300, 300 minus 75, 225, 225 minus 50, 175. Is this the cash flow we found out? Yes, 175 is the cash flow we have arrived at. So here also, opening and closing, whatever is the difference, you have to adjust, but there is a slight change here. What you need to observe is, we have adjusted 150 minus 200 minus 50. In other words, here we have done closing balance minus opening balance. For inventory we did opening minus closing. For debtors we did opening minus closing. For creditors we are doing closing minus opening. So to summarize, if it was an asset impacting the operating cash flow, that is for example inventory or debtor, there you would say opening minus closing. If it was a credit item, if it was a credit item, for example creditors, which is required to be adjusted for computing the operating cash flow, you will consider closing minus opening. You will consider closing minus opening. So once you do this adjustment, you can arrive at cash flow from operating activities. So continuing with our example, purchases are on credit, sales are on credit, our net profit is 250. Now let's add one more item. What is that item? Let's say we have a bad debt. A particular customer did not pay us the amount, the bad debt amounted to 25. The bad debt amounted to 25. Now, what would happen to the profit? 1150 on the credit side, minus 200, minus 700, that brings it to 250, minus 25, our net profit is now 225. Let's assume creditors there is no impact, balance part on debtors also there is no impact. Now, if you come to the debtors account, you will have one more entry here saying by bad debt 25, and 925 is not what you have collected. You would have collected 1150 minus 250, you would have collected 900. What would happen to your cash flow? 900 minus 750, it would have been 150. It would have been 150. Now, this was another direct method. If I have to present it in the format of the indirect method, what will I do? Net profit will change. Instead of 250, it will become 225, and automatically your cash flow gets adjusted. So 225 plus 50, 275, minus 75, 200, minus 50, 150. So this now becomes 150. So this automatically get adjusted. Now, one thing that you need to understand is, how did this bad debt get automatically adjusted? It is not automatically adjusted. What is happening is, I made a sales of 1000. Assume I collected all 1000. Just assume I collected all 1000. So there is no bad debt. But assume debtors amounting to 25 rupees did not pay. So what happens? I should have collected 1000, but I collected only 975. Now I have to reduce this 25 because I have added 1000 here. That 25 has to be reduced. So I have reduced it here. So it automatically gets adjusted in the profit and no further adjustment is required. Now, a simple way to remember this in your examination, we have understood what is the logic. We have understood what is the logic. A simple way to remember this in the examination is, segregate the items into two parts. Now if you see, we have talked about inventories, we have talked about debtors, we have talked about creditors. We are talking about those working capital components, all the current assets and the current liabilities. We started with inventory, we took the example of debtors, the adjustment was similar, and then we also understood creditor where adjustment was exactly reversed. So there are two categories that we are talking about. One, current assets, second, current liabilities, right? Whenever you are preparing cash flow using indirect method, you will start with net profit, you will do some changes. One of those changes is the changes in current assets and current liabilities, and we know current assets minus current liabilities what? This gives us working capital. So we are talking about working capital changes. Now whenever you have to adjust these working capital changes, now for example when we said inventory, you consider opening balance minus closing balance. For current liabilities, just do the reverse, just do the ulta, that is closing balance minus opening balance. Okay. Now if for example under current assets, opening is greater than closing, if opening is greater than closing, will this be positive or negative? This particular item will be positive. So you will add. What will you do? This implies you will add. On the other hand, if opening is less than closing, you will deduct, because when you say opening is less than closing, opening balance minus closing balance will be negative. Come to the other side, current liabilities, closing minus opening. So if you use closing minus opening and opening is greater than closing, so if opening is greater than closing, this number will be negative, so you will do a reduction. Similarly, if it is a reverse case where opening is less than closing, you will do an addition. So this is the summary of adjustments you will be doing when you have to adjust the working capital changes. So if opening is greater than closing means there is a reduction in debtors or there is reduction in current assets, you will add. If there is a reverse case, you will deduct. Here you will deduct, here you will add, right? So this is one way to remember. Let us take a couple of minutes to actually look into the what does this logic mean. So if you come to this creditors account, we said we have opening balance of 200, closing balance of 150. So can I say I paid 50 rupees more to the creditors, or I paid 50 rupees to the creditors which is extra or over and above my purchases? That is what is the excess payment, and when you do this 150 minus 200, that is the 50 rupees which you are adjusting. So you are looking it as a balance as if you have paid 50 rupees more to the creditor. Now that 50 rupees has to be deducted. So 150 minus 200, closing minus opening, 150 minus 200 minus 50 will be adjusted. So when you come to the debtors, opening balance 150, closing balance 225. I am assuming as if I have collected 75 rupees less from the debtors. Whatever is the increase in balance, I could not collect, I have collected less, right? So that is why we adjust. The reason being, this entire 1000 rupees is already factored into my profit, but I could not collect the entire 1000 rupees. Whatever is the incremental part I could not collect, that is represented by opening minus closing minus 75, here I will be reducing. So this is the logic of deriving the working capital changes. As we do more and more problems, we will have more clarity into these items. Now the logic that we discussed for inventory and debtors hold goods for any other current asset item which will somehow impact the P&L account. For example, there is a prepaid expense, same logic holds good. If there are any other creditors or credit items or payables, like you have to pay employee salaries, now that impacts the P&L as expense, even there also it holds good, right? So that logic of current assets, current liabilities holds good for all working capital adjustments when we are doing cash flow from operating activities. See, so far whatever we have discussed, we have not touched upon other aspects. We are just talking about sales and purchases, which are the core operating activities. Now let us add some more elements to this part. Let us say in our P&L, apart from the purchases and bad debt, we also have a depreciation entry. So we have to depreciation 100. Now to depreciation 100 I have written, so I have 1150 minus 900, 250 minus 125, I get a profit of 2, net profit 125. Now I deducted an item and I reduced my net profit. I deducted an item and I reduced my net profit. Is depreciation a cash outflow? That is my question. Is depreciation a cash outflow? When we purchased a fixed asset, we definitely would have paid some money. That is definitely a cash outflow. But is depreciation a cash outflow? The answer to that is no. Depreciation is not an outflow. The company will not pay any amount towards depreciation. Again I am repeating, while purchasing fixed assets you will pay the amount. That will deal separately in the investment activity. But depreciation as such, as an entry, there is no cash outflow. If I say to salary, I know I have to pay salary, I will be paying salary. But when I say depreciation, I will not be paying anything. Now I have reduced the net profit by 125. Now if I have to again prepare a statement starting from net profit of 125 and to arrive at the cash flows, I very well know that this 100 is not my outflow. But did I deduct it to arrive at the net profit? The answer to that is yes. I reduced 100 and I arrived at the net profit of 125, but that is not my outflow. So what do? I simply add back. So come to your cash flow statement. When we are preparing cash flow from operating activities, so my net profit currently stands at 125, but I know my depreciation is not a cash outflow. I will say add non-cash item, which is depreciation of 100. So earlier here I had 225, I debited 100, I made it 125. I am adding back the depreciation again, because from the net profit, if I have to arrive at the cash flow, I have to add back all those items which were deducted at arriving at net profit, but they are not actually cash flows, right? There is no cash outflow for depreciation. I simply change this 225 to 125 by passing an accounting entry, which does not result in cash outflow. So because it has reduced the profit, to arrive at the cash flow position, I will need to add it back. So 125 plus 100, 225 plus 50, 275 minus 75, 200 minus 50, 150. See, this part of the cash flow statement did not change. Just because I added a depreciation entry, this part of the cash flow did not change. So if I am passing any entry, if I am making any provision which does not impact my cash flow, such items I should add back to the net profit to arrive at the cash flow from operating activities. Say for example, I pass an entry saying provision for taxation. Now please note, provision for taxation, there is no actual cash outflow. Cash outflow happens when you actually pay the tax. So even provision for taxation you have to add back. Provision for tax should also be added back because tax we have to disclose separately. That is one reason. The other reason is provision for taxation does not represent any outflow. Let's say I pass another entry. Let us say instead of depreciation, here I have some provision for taxation. I have some provision for taxation. Now is this 100 an outflow? This 100 is not an outflow. If I have made some outflow, if I made some payment, I can see that in the taxes paid account or the advance tax account or any other account which represents tax payment. Provision for tax does not represent an outflow. So this also you will add back to the net profit to arrive at cash flow from operating activities, right? So whenever there is a non-cash expense which is hitting your profit and loss account, you will have to adjust that. You will have to adjust that to reflect the true cash flow position. So whenever you start with net profit as the starting point or net profit before taxes as the starting point, you will add back all the non-cash expenses. You will add back all the non-cash expenses and you will also do the working capital changes adjustment and you will arrive at the cash flow from operations or cash flow from operating activities. Now let us add some more complexities. Let us say there is another income. Let's say you have gain on sale of fixed assets 50. You sold some fixed asset. You got a gain on sale of fixed asset. How much is that? That is 50. Now what happens to your profit? Profit from 125 now increases to 175 because you have added an item of 50 on the credit side, right? Now, sale of fixed asset or fixed asset sale, what is the category of the cash flow? Is it operations, investing or financing? We know that whatever is related to fixed asset, we'll classify them under cash flow from investing activities or investment activities. If there is any gain or loss related to an investment activity, I cannot show it under the operating activities. So, when I am preparing this cash flow from operating activities, please note I am doing only from operating activity. Any non-operating activity related cash flows or gains or losses should also be excluded, which means though there is a net profit of 175 to start with, I should remove this 50 while computing the cash flow from operating activities. Sir, then where will this 50 go? Will we take this 50 under cash flow from investment activities? Again, the answer is no. Now you may be surprised, sir, we have not considered in operating, we have not considered in investment activities. Where will we consider that? See, we will consider sale of fixed asset. We will consider sale of fixed asset under the investment activities. Maybe I have sold the fixed asset for 1000. So my cash flow is 1000. Gain is not a cash flow. So first adjustment or first treatment is you will remove from the net profit while computing the operating activity. And you will find out what is the cash flow, what should have been the cash flow on account of sale of the fixed asset, and to that extent you will adjust in the investment activity, right? So any item which is a non-cash item, that you will remove. Any item which is not an operating item, that also you will remove. We took the example of sale of fixed asset. What could other examples be? There could be interest payment. Is interest payment on loan cash payment from operating activities? The answer to that is no. Is dividend income received? Is that a cash flow from operating activities? No. Dividend income should go to the investment activities. If you have paid the dividend, if the company has paid the dividend, should it form a part of operating activities? Again, no. That will be shown under the financing activity. So you have to be careful in choosing what are the items which we need to exclude while computing cash flow from operating activities. So when you start with net profit, the points that you need to keep in mind is, first, remove all the non-cash items. Remove all the non-cash items or non-cash expenses. Second, remove all those items which pertain to financing or investment activity. Third, do the working capital changes. And lastly, account for income tax payment or adjust the income tax payment. You will get the cash flow from operating activities. Now, sometimes what may happen is they will not give you profit and loss account for the year. Instead, what they will say is opening profit balance is so much, closing profit balance is so much. Say for example, you have year 1, you have year 2, this is your profit and loss balance. Here it is 1000, here it is 1200. So this is the information that is given to you. Now, if nothing else is mentioned, can I safely assume that the company has earned profit of 200 during the period? Because from year 1 to year 2, the increase is 200. So this 200 in the P&L could have come only if the company would have earned 200 of profits, right? This is one way where you have to extract the information and draw necessary conclusion. But let's say one additional information is given. What is that one additional information? Dividends paid during the year is 20. Dividend paid during the year is 20. Ignore the dividend distribution tax for now. Dividend paid during the year is 20. Then can I still say this 200 is my profit? The answer to that is no. Let us see how much of profit has the company earned. If I draw up a P&L account for the company, I know there is a balance brought down. P&L has a credit balance brought down of 1000. Balance carried down. How much is the balance carried down? Balance carried down of 1200. During the year, the company earned how much of profits? We don't know. But what we know is the company has paid dividends of 20. Now, when you pay dividends, what will happen to the P&L balance? The P&L balance will come down. So, what you would say? To dividends paid 20. So, if you have to balance this account, 1220 is this side is 1000. So, what is the balancing figure? That is the profit for year 2. This is your balancing figure. 1220 minus 1000. 220. This becomes 1220. So the profit for the year, if the dividend information is given, it is 220. What does this mean? Opening balance was 1000. To that the company added 220 as their profit. From this they paid 20 as dividend. So they got a closing balance of 1200. So like this you will need to extract information from the question. Sometimes it may so happen that not just dividend, they will say, second adjustment could be transfer to general reserve, let's say 50, which means here there is an entry to general reserve 50. This no longer remains 220, this becomes 270. So this becomes 1270, 1270. So in this way you have to extract the relevant information, right? Now this gives us a broad overview of how do we compute cash flow from operating activities using the indirect method. We will take a small illustration now, solve that illustration using both direct and indirect method, and then proceed towards investing and financing activities. Let's look at one illustration where we will be preparing cash flow from operating activities using both the direct method and the indirect method. Once we solve this problem, we will be in a good position to understand how the treatment changes when we switch from direct method to indirect method. So let's look at the illustration. Given below is the statement of profit and loss of ABC Limited and relevant balance sheet information. Now friends, we had been discussing that to prepare cash flow under the direct method, generally we will get summary of the cash book or the summary of cash account. But in this case, they have not given us summary of cash account, they have given us profit and loss account and balance sheet. Using the information, we will understand how to derive the cash flow from each individual activity, right? So we have revenue. Under revenue we have sales, interest and dividend, that is your income. Then stock adjustment, total comes to 4270. On the expenditure side we have purchases, wages and salaries, other expenses, interest, depreciation and profit before tax. So profit before tax is given as 710. Then you have tax provision of 200. Profit after tax for the year 510, and you have balance of profit and loss account brought forward. This is nothing but the opening profit and loss account balance, which is 50. Then profit available for distribution, whatever you have earned plus whatever is the opening balance, the total available is 560. Out of that 200 has been transferred to general reserve. Dividend declared including DDT, that is dividend distribution tax, it comes to 330. And the balance which will remain in the balance sheet is 30. This is the information from profit and loss account. If you look at the balance sheet information, they have given selected information like trade receivables, opening balance, closing balance, inventories, trade payable, outstanding wages, outstanding expenses, advance tax and tax provision. So tax provision is 200 and 180. Now with this information we have to prepare the cash flow statement both under the direct method and under the indirect method. Now when we have to prepare cash flow statement under the direct method, what we need is how much cash have we collected from the customers, how much cash have we paid to the suppliers, how much cash have we paid towards the expenses. This is the information that we would be requiring. So to find out these information, first we will need to do some working notes, and once these information are available, we can go ahead and prepare the cash flow statement. Now to prepare cash flow under the direct method, that is cash flow from operating activities under the direct method, we need to know how much money did we collect from the customers. We need to know how much money we paid to the suppliers. Now because a summary of cash statement is not given, a summary of cash account is not given, what we will do is we will prepare each of those ledgers account and find out how much money have we collected and how much money have we paid. To begin with, we will start with accounts receivable or the debtors account. So if you see, you have trade receivables, okay. Trade receivables, what is the opening balance? The opening balance given is 250 lakhs. So we will just say in rupee lakhs, the opening balance is 250. So to balance brought down 250. Then during the period we have made sales of 4150. That also will be debited to trade receivable account. To sales 4150. 50. And what is the closing balance? The closing balance is given as 400 by balance carried down 400. Now, if you look at the debit side, you have a total of 4400. On the credit side, you have one entry of 400. What is the balancing figure? 4400 minus 400. 4000 is your balancing figure. That is the amount you would have collected from the customers, because there is no other information that you have given some discount or you have given some bad dates. Such information is not available. So this balancing figure is nothing but amount collected by bank balancing figure, right? Now this is one way of doing, by preparing a ledger account. Now the same amount can be computed by preparing a statement. How do we prepare a statement? See, the closing balance of debtors is equal to opening balance plus sales minus receipts, correct? Bring receipts this side, take this closing balance to the other side. You will have receipts is equal to opening balance plus sales minus closing balance. So this you can put in a statement format like opening balance is given as 250, add sales is given as 4150 minus closing balance is given as 400. So this comes to 4000. This is also an appropriate way to arrive at the amount collected from the customers. Now when we have this amount, we can start preparing our cash flow statement as well. So what we'll do is, so we can have cash flow from operating activities, direct method. We are talking about direct method, particulars and amount. What is the first item? Cash collected from trade receivable. Cash collected from trade receivables, we have computed it as 4000. Then what are the other items in the P&L which could be related to operating activity? The next inflow or the next item is interest and dividend. Now if you have earned interest income or if you have earned dividend income, that is not related to your operating activity, that is related to your investment activity. Then you have stock adjustment. Now this stock adjustment is nothing but the difference between opening stock and closing stock. So if closing stock is higher, they have put it on the credit side. So that is also not a cash flow related item. So on inflow side, you have only debtors. As you move ahead, on the expenditure side, you see purchases, 2400 of purchases. But is that the amount that we would have paid to the suppliers? The answer to that is no. We would have paid some other amount which we can find out by preparing a ledger account. So like we prepared the debtors account, we will also prepare the creditors account or trade payables account. So put a heading trade payables, right? So what is the balance? By balance brought down. What is the amount? Trade payables, the amount is 230. Opening balance is 230. Purchases as per the question given is 2400. So purchases you will credit. So by purchases, how much is the amount? 2400. And you have balance, closing balance of to balance carried down. Closing balance is given as 250. 250 is your closing balance. So this side it becomes 2630. 2630 minus 250, that comes to 2380. So you would have paid, which is your balancing figure, 2380, right? This is a cash outflow. So what you can do is you can put into the cash flow statement as cash paid to the suppliers. So cash paid to suppliers, the amount is 2380. It is always a good habit to put the outflows inside the brackets, right? Now can we do the same thing as a statement? Yes, we can do the same thing as a statement. So how will you prepare a statement for that? Can I say opening balance plus purchases minus closing balance is what I have paid? Absolutely, yes, I can say that as well. So what is the opening balance? The opening balance is given as 230. Purchases 2400. Closing balance of 250, right? So If I reduce this, I get 2380, right? That part is also done. Now, then we have wages and salaries and other expenses. Now, wages and salary and other expenses they have given as in the P&L statement 800 for wages and salary and other expenses of 200. But did we pay the same amount? The answer to that is no, because if you look at the balance sheet, you have some outstanding wages, opening balance of 40, closing balance of 50. You have some outstanding expenses, opening balance of 10, closing balance of 20. So, even for these, we will need to prepare either a ledger account or prepare a statement, right? Let's do it with the help of a ledger account. So, first let's see wages payable. Wages payable. What is the opening balance? The opening balance of wages payable is 40. So, this is on the credit side. Closing balance is 50. How much has been debited to P&L? We have debited 800 to the P&L. So, by wages for the current period it is 800. 800 plus 40, 840. This side also it will be 840. 840 minus 50, 790. This is what we have paid. So, to bank, balancing figure 790 is the wage that has been paid. So, cash paid towards wages. Cash paid towards wages, the amount is 790. This is again an outflow. Same thing, can I compute using the statement? Yes, I can use it. I can compute it using the statement. Wages, opening balance 40, current period charge 800, closing balance 50. This comes to 790. This is what has been paid, right? So, in the same manner, I can compute amount towards other expenses. So, I can have other expenses here. Opening balance of other expenses payable 10, amount charged to P&L 200, closing balance of 20. So, 10 plus 100, 200, 200 minus 20, 180. This is paid, this is paid, this is paid, this is received, right? Same way I can also prepare it in a ledger account. So, what is the payment? The payment is 180. Come to the cash flow statement. Cash paid towards expenses 180. So, for other expenses you have opening balance of 10 plus 200, that makes it 210, minus 20 you get 190. This is what is received, this is what is paid, this is also paid, this is also paid. Now, this 190 I can derive by preparing a ledger account as well. Now, sir, which format do we use? How should we present in the examination? You can do it either using a ledger account or using a statement. For simpler transaction, if you can prepare this in a statement format, you will be saving some time because you don't need to draw ledgers again and again. Also, while preparing ledgers, you don't need to write date, particulars, amount. You can simply prepare a T-shaped ledger, write the ledger heading, and then pass the necessary entries. So, let's post this 190 in the cash flow statement. So, the cash paid towards expenses is 190. Now, if you look at the question, after other expenses, we have interest. Interest is an outflow, but is it an outflow from operating activity? The answer to that is no. It is from financing activity. Then depreciation, is it an outflow from operating activity? No. Is it an outflow from investing activity? No, because depreciation is a non-cash expenditure. There is no outflow involved in depreciation. Then we have tax provision. Now, when we say we have tax provision, is it that the tax provision is the actual tax paid? Again, the answer to that is no. So, you ignore the tax provision, you should actually find out what is the tax paid during the year. Okay. So, for that again we have to prepare a working. Tax provision generally if you prepare using a ledger account, it will be much clearer. We will prepare a ledger statement for tax provision and tax paid and figure out how much tax has been actually paid. So, we will have provision for tax account and advance tax account. Now, you may have a doubt. So, why do we need to prepare provision for tax account and advance tax account as well? these two accounts are interrelated, and till the time you know how much of provision balance we are carrying forward, or how much of provision has already been set off against advance tax, we will not be in a position to find out the actual taxes paid during the period. In this question it is pretty straightforward. We could have done without ledger accounts as well, but we need to get our concepts right starting at the first problem itself. So let's see how much is the provision for tax. The tax provision opening balance, it will be a credit item. So by balance carried down you have 180, and to balance carried down you have 200. In advance tax also you can see 180 as the opening balance. So to balance brought down 180 by balance carried down you have 195. Now generally what happens is this provision for tax, whatever we have paid, is knocked off against the advance taxes that we have paid, but this is done when the assessment is completed. What is assessment and all, you'll understand when you do income tax. So whenever an assessment is completed, the provision and the advance tax, they are set off against each other. Generally, if nothing is mentioned, we can safely assume in the next year we have got the assessment order and these two amounts can be set off. So what we will do is, this balance brought down of 180 will be knocked off against the provision. So the entry will be by provision for tax. So this 180 will be transferred. So in provision for tax you will have to advance tax 180, right? Then in the current period, what is the provision you have created? If you go to the P&L account, it says provision for tax 200. So by profit and loss account, for provision that you have created in the current period, by profit and loss account, amount is 200. This is the same amount that is being carried down as the closing balance of taxation, right? Now come to the advance tax account. You had opening balance of 180, then you have a balance carried down of 195. Now if assume I had not passed this entry, if I had not passed this entry of transfer, I would have been saying opening balance is 180, I paid 15 rupees towards taxation, but that is not the correct structure. That is not the correct interpretation. This 180 has been knocked off against the opening provision. So 195 plus 180 minus 180. So in this year the company has in effect paid 195 as advance tax. So to bank 195. This becomes 375. Here also you have 375. So this is the amount that has been paid as taxes in the current period. I hope it is clear. Now instead of preparing two separate accounts for provision for taxation and advance tax, I can have a single account capturing both provision for taxation and advance tax account. Let's see how does it look like. So you can have provision for tax plus advance tax in a single account. Now when I have a single account, I will have to balance brought down, this is of advance tax, to balance brought down as per the question it is given as 180, provision by balance brought down, this is the provision which is 180. Then when I have both of them in the same account, there is no need of transferring from one ledger to another ledger. The second thing that happened is we created a provision for taxation of 200. So you will say by P&L provision for tax of the current year. How much is that? That is 200. Then you have balance carried down of advance tax as 195. So that will be on the credit side. By balance carried down, this is for advance tax 195, to balance carried down, this is for provision. What is the amount? The amount is given as 200. So if you see 200 plus 180 minus 200 minus 180 minus 195, the net figure becomes 195. So to bank balancing figure 195. So you can prepare in a single ledger statement as well. Now this 195 is the actual taxes paid. Now friends, even if we are doing the indirect method, right now we are doing it for direct method, even under the indirect method, tax computation will be done in the same manner. So now come to the cash flow statement. If you find out what is the cash flow before taxes, let's see how much is that. 4,000 of inflow minus 2380 paid to suppliers minus 790 minus 190, you have 640. Now this 640 is cash flow generated from operations before taxes. How much is that? That is 640. Now always remember, you will have to show taxes separately. So what you will say? You would say less income tax paid 195, again within brackets. So if you find out, this becomes, if you subtract this, 0 minus 5 is 5, 13 minus 9 is 4, and 5 minus 1 is 4. 445, that is cash generated from operations, right? This is what has been asked in the question, and which is 445. Now, how do we remember this format? The remembering of the format will happen automatically as you practice more and more problem, but the logic is you will have to capture all the cash inflows, all the cash outflows, and you have to reduce the taxes separately. Once you do this, your cash flow from operating activities becomes simple. Now, let us prepare the cash flow from operating activities under the indirect method. So, I'll just mention it as under indirect method. Now, when we are talking about indirect method, we are not concerned with what is the cash inflow, cash outflow at an individual level. For example, we are not concerned how much money have we collected from the debtors. The way we will have to start this problem is, or the way we will have to start preparation of cash flow is, start from net profit before taxation. Where do we start from? Net profit before taxation. So, first item will be net profit before taxation. So, how much is that? Net profit before taxation is given as 710. Please pay utmost attention. You have to start from profit before taxation. So, that is 710. Now, once you have arrived, or once you have started from profit before taxation, you know that this profit has been arrived after considering certain expenses, after considering certain income on accrual basis, right? So, if we have to prepare cash flow from operating activity, the first thing to do is eliminate all those items which are either non-cash expenses or non-cash inflows, or items which are not related to operating activity. For example, something like interest paid. Now, interest paid is a financing activity. Did I consider interest paid when I computed the net profit? 101%. The answer is yes. So, when I am preparing the cash flow from operating activity, I very well know that interest is not an operating activity item. Exclude that, remove the impact of interest, remove the impact of dividends, remove the impact of depreciation. Why? Because depreciation does not involve any cash outflow. So, the first thing that you need to do is add or less those items which are either non-cash items, or they are such items which pertain to other heads, right? So, if you look at the profit and loss account, what is the non-cash item? You can see now, since we have considered profit before tax, items below that is no longer relevant. You have to start looking items above profit before tax. You can see there is an item of depreciation. So, depreciation is a non-cash item. So, we have to add back. Why add back? Because when we prepared the profit and loss account, we deducted depreciation to arrive at the net profit. Since there is no cash outflow involved, I do not need to deduct this depreciation while preparing cash flow. So, I need to consider net profit even before depreciation. So, what is the first adjustment? Add non-cash items. What is the non-cash item here? Here you have only one item, depreciation. And why are we adding back? Because we deducted depreciation while arriving at net profit, and depreciation does not involve any cash outflow. So, that the effect of that earlier deduction we are nullifying. How much is the depreciation? The depreciation given in the question is 100. So, add back 100. Then, are there any other non-cash items? No. Then we have to add back or deduct those items which pertains to other head. So, add or less items under other heads. right? Now when we are adding or deducting item under other heads, which means those items which were included while computing the net profit but now are forming part of other heads, or they will be classified under other activities. What are those items? If you look at the profit and loss account, on the income side you can see interest and dividend of 100. Now this interest and dividend of 100 is not relevant to operating activity. Whatever cash you would have received against this interest and dividend, that is a part of the investment activity. So the effect of this 100 should be excluded or should be reversed. So first item is interest and dividend. How much is the amount? The amount is 100. The amount is 100. So should I add 100 or should I reduce 100? See, when we computed the net profit, because this is an income item, we would have added. Now we know that out of this net profit of 710, anything related to this 100 is not relevant to operating cash flow. It is relevant to investing cash flow. So we have to remove the effect of this 100. Now since earlier we have added this, now we will have to reduce this, right? When we computed net profit, we have added 100. Now while adjusting it for cash flow, we will remove 100. So just remove 100. That's why we show it as a negative item. If you have added earlier, reduce now. If you had reduced earlier, add now. The next item which is not pertaining to operating activity is interest expense. So we have interest expense and the amount of interest expense is 60. Now because we had deducted 60 while computing the net profit, now you will be adding back. We are nullifying the effect, we are reversing the effect of these items because these are not related to operating activity. So now you will add back. Now you have 710 plus 100, that makes it 810 minus 100, again 710 plus 60, you get 770. Now what did we do so far? We took the net profit, we excluded those items which are non-cash in nature. We also excluded those items which were either financing or investment, which were either financing related items or investment related items. This number is also called operating profit before working capital changes. So before working capital changes, before giving impact of working capital changes, this is the operating profit. Okay. Now after this, the next thing that we need to do is we have to factor for changes in working capital. So you'll have changes in working capital. Now what are these changes in working capital? See, like we discussed in our earlier modules, that you will have to give the impact of difference between opening stock and closing stock, opening debtor and closing debtor, opening creditors and closing creditors, so that you arrive at the cash flow. Because this number of 770 includes cash items as well as non-cash items, meaning to say 770 includes those items of sales, those items of expenses for which you would not have even paid cash. Okay, you will be paying the cash for such items in the future. So the impact of such items will be removed. You have to adjust for that. For that we have changes in working capital. Now the changes in working capital adjustment, as we discussed earlier, depends whether it is on the asset side or on the liability side. Let us take item by item and plot them into this cash flow statement. If you look at the inventories, opening balance 180, closing balance is 200, and please remember what we discussed earlier. For assets related items, you will see opening minus closing, opening minus closing. Here opening minus closing is minus 20. So directly I can write minus 20, but just by writing the number I will not get marks. I have to say this is a change in inventory, and more precisely you will write whether it is increase in inventory or decrease in inventory. We know from 180 to 200 it is increase in inventory. So you will say increase in inventory. Then the next item is trade receivables. Now trade receivables also, if you see, from 250 it has become 400, and for asset we said we will see opening minus closing. So increase in trade receivables that is 250 minus 400, 150. Then we have trade payables. So it's always better to first tackle the asset items and then go to the liability items, so that you don't miss out on the logic. Sometimes what happens is, while doing increase in debtor, if you give the same treatment for increase in creditor, then your cash flow will not match, right? The next item is trade payable. Again there is an increase, and for trade payable we have said, or for liabilities we have said, we'll see closing minus opening. So here also we have increase in trade payable, but here it is positive, closing minus opening, 250 minus 230, positive of 20. Then you have outstanding wages and outstanding expenses, both the balances have increased. So you can say increase in outstanding wages, increase in outstanding expenses. So wages, if you see, from 40 to 50, but for liability you will see closing minus opening. So 50 minus 40 you will get 10 here, 20 minus 10 you will get 10 here, right? So these are the working capital adjustments. I'll again take you through all these working capital adjustments. So for inventory we'll do opening minus closing, for debtors we'll do opening minus closing, these are the asset side. For creditors or for liabilities we will do closing minus opening, and this is how you will get the number. So if opening minus closing, for example in case of inventory it is 180 minus 200, it becomes minus 20. For debtors it is 250 minus 400, so it becomes 150. The other way to remember this, in case you tend to forget, the other way to remember this is, if my debtors have gone up from 250 to 400, which means opening balance plus whatever sales I have made, I have collected 150 less. In the sales I have considered 100%, but now I have actually collected 150 less in the current year. So this has to be reduced. This is another way to remember. But the best way to remember is see inventory and remember it has to be opening minus closing. Now from the 770 you will need to do the working capital adjustments. Now we have already plotted what has to be added, what has to be deducted. So you have 770 minus 20, 750, 750 minus 150, 600, 600 plus 40, it is 640. This is also called as cash generated from operations before taxes, right? Now this is what has been generated before taxes. Now let's see whether this number of 640 matches with our earlier working. So if you go back to the earlier working, even here we had 640. So this number very well matches, right? Then after this we have to do the tax adjustment and get the cash flow from operating activities. Before we move further, let me quickly revise how did we do this pluses and minuses. We said for inventory, always remember you will do opening minus closing, or for assets you will do opening minus closing, whatever is the resulting number you will adjust, right? Opening inventory was 180, you did 180 minus 200 minus 20 is the adjustment. Just ulta for the creditors or the payables, just reverse it for the creditors or the payable, that there you will do closing minus opening. Right? Now this will give you the working capital adjustments. One small hint to still remember it further in case you tend to forget is that when I say my opening balance of debtors is 250 and my closing balance is 400, which means that opening plus whatever I have sold, I have collected 150 lesser, because while computing the net profit, I have put in all the sales that I have made, and out of the all sales that I have made, I have collected 150 lesser. That is how my balance has increased from 250 to 400, right? This is another way to remember. Now after this, you will give the impact of taxes. As I told you earlier, amount of taxes paid will not be different between the direct method and the indirect method. In both the cases, it will be 195. So less taxes paid 195. So 640 minus 195, you have 5 here, 13 minus 9, 4 here and 4 here. So 445. This is the cash generated from operating activity. 445. Is it the same? Even earlier we had computed 445. So what has changed is, here you have just put up respective amounts, like from debtors how much did I collect, So here from trade receivables, how much did I collect? To suppliers, how much did I pay? To wages, how much did I pay? Expenses, how much did I pay? And then I find out the cash flow. Here there is no linkage with profit, but when you come to the indirect method, you actually try to link it with your 710 of profit. You are showing a profit of 710, and after you adjust non-operating items, you are saying 770 is the profit, but the cash flow generated is 445. But the net cash flow generated is 640 minus taxes will give you 445. This is how you need to understand cash flow statements.